Hi, my name is Harris. I'm one of your podcast hosts. I'm also a lawyer at Treadstone Law. For most Canadians, buying, selling, or refinancing real estate, a lawyer is the last thing on their mind. That's unfortunate because lawyers play a vital role in the process. But what choices do Canadians have? Lawyers can be very expensive. Well, Treadstone Law offers resources to Canadians so they have access to the information they need. Whether you sign up for a live workshop or a mailing list, we cover topics to help you make informed decisions and avoid costly mistakes. It's advice you can start using today, and best of all, it's free. Visit treadstonelaw.ca/MAS offer or click the link below to get access right now. If you're looking to retain Treadstone Law, it's never been easier. Our entire process is online. From completing the retainer agreement to your signing appointment, everything is done from the comfort of your own home. We're your digital lawyers. The best part of it is that you don't pay anything when you're retaining our firm. Visit treadstonelaw.ca/MAS offer or click on the link below to retain us right now. Enjoy the podcast. Welcome to another episode of Hustle and Grit. Today on our podcast, we've got Leigh Graham. Leigh has spent 17 years in the industry and 15 years spent with the mortgage professionals. He began his lending career after being drafted from the ranks of TD Canada Trust. Mentored under the founders and previous owners of the mortgage professionals, Leigh opened a successful branch office in 2006. When he's not working hard to find you the best deal, he is an avid squash player and enjoying spending time with his 4 charming children and loving wife. How are you doing, Leigh?
Excellent, man. How are you?
Good. You know what? I went through your profile a little bit, and safe to say you've spent your entire career in mortgages. It wasn't something that you kind of jumped into. What kind of led you to kind of go into the mortgage industry?
Yeah, great question. It was a very it wasn't the kind of thing that I spent sort of my school years looking forward to. To be quite honest with you, until I worked for the bank, I didn't realize it was actually even a career to
Hmm.
be had. But no, the real answer, the honest answer is my wife and I got uh, got got pregnant when we were in university. We had a kid at a very young age, and I had to get something going. I quit school. We were in university, and she stayed in, but I dropped out and got a job working in Kingston, and that led to a job at the bank, and that bank job led to an opportunity with the mortgage professionals. So those numbers are a little bit out of date. Those are pre-COVID numbers. I'll be with the company almost 19 years now. So, but that's the real answer. And I remember the founders, the guys who started the company, who were customers at the bank at the time, and that's how I met them. Um, I remember them telling me one thing, which was basically this business is about people, and if you're good with people, if you're passionate about people, if you believe in doing the right thing for people, serving customers and whatnot, the rest of it's just paperwork. And at the time, that sounded very appealing. I'm happy to say it's worked out so far.
So, what made you jump from TD into mortgage brokering? Because I find, I mean, it's a little bit more difficult, arguably, to be a mortgage broker because with TD, it's easy to know one bank's products, but as a mortgage broker, you have to know a lot of lenders, a lot of different requirements, a lot of different customer profiles, and so it's a bit daunting. And there's not necessarily you only get paid on the deals that you're successful with. So if you help your clients, you get paid, and if you don't close, you don't get paid. So what made you kind of jump from TD into just mortgage brokering?
Yeah, all those things that you just said are perfectly accurate. It's a sales-based profession, without question, and that wasn't, it didn't seem to offer the stability at the start that obviously I needed at that time. Again, we were very young and had a young family and stuff, and but conversely, at that point in time, so this is the early 2000s. TD and Canada Trust had just completed their merger, and the opportunities for advancement just weren't there for me in our community. So again, it was all very fortuitous. I was offered a job with the mortgage professionals in an administrative role, where I reported directly to the two senior partners, the two founding partners, and that gave me two things. One was a consistent paycheck while working
Mm-hmm.
directly for them, but also then an opportunity to learn the business organically while watching them do it. And these guys were, writing hundreds and hundreds of mortgages a year at that time. One of them is now retired. The other one is essentially semi-retired. And I, not a day goes by where I'm not grateful for that opportunity. But yeah, it wasn't as much I guess it was more of a jump to sort of get, perhaps expand my own personal opportunities more than anything,
Mm-hmm.
simply because at that time the banking world just didn't offer, the kind of economic support that I would have needed. The bank was a great job. They have there's perks and benefits and there's all those things. Ironically, we still arrange TD Bank mortgages today.
Yeah.
So to your comment about to your comment about different products, I mean that's a whole separate conversation which we can have. But at the time, again, it just sort of it fit what path my life needed to be on at that point. I had no idea even at that time if it was going to be a long-term strategy, to be quite honest. But very shortly after I joined the company, it seemed like it was a good, certainly it was a good fit. But there's definitely the trade-off. There's definitely a trade-off between the stability of working for
Mm-hmm.
a company and the risk associated with essentially working for yourself. There's absolutely no question that those are
Yeah.
two entirely different.
So having worked at TD Canada Trust and then having worked under or getting your initial experience with the owners of the firm and now being an owner yourself, what would you say makes a good mortgage broker? What is somebody, if I was looking, and I always tell my clients, if anybody's looking for a mortgage, to go to a mortgage broker, and I'm going to touch upon that a little bit later, but would you consider? What should they be looking at? What makes a good mortgage broker in terms of helping clients out within whatever credit facilities they need?
Yeah, that's a great question as well. In my opinion, what makes a great mortgage broker, what makes a good mortgage broker, is the one who's going to help that consumer, that homeowner, that prospective homeowner, whoever that person may be, regardless of their circumstance. It's very easy in some cases to, um, you know, how do I'm trying to put this lightly, I guess, but it's very easy to pass judgment, for example, on somebody whose circumstances may seem prohibitive or may seem
Mm-hmm.
daunting or something like that. And I found that, I've operated primarily throughout most of my career in a very small market, a very small community, and I can't, as a result, I can't really tell somebody bad news or really not, look like I've done the best for somebody because I'm going to see that person at the grocery store before I go home today. So really, just from a self-preservation standpoint, I would always be very conscious about the kind of advice that I was giving people, whether whether it was the kind of thing they wanted to hear or not.
Mm-hmm.
Being truthful, being honest, being direct. That's, in my opinion, that's what makes a good mortgage broker. And when I look around the country and I see my contemporaries and the people that, I've gotten to know over the years, whether they be high performing brokers or whether they
Yeah.
be broker owners, or both. That's a pretty consistent line. Is people who are practiced at telling people how it is, whether it's the news the consumer wants to hear or not. You have to be able to share that in a respectful and a gracious way, and that tends to lead to, fostering much deeper, much more significant relationships, and in turn more business. Even if it's not that particular consumer that you served, they'll remember how you made them feel while you handled them through, a difficult situation. And that, in my opinion, is that's what makes a good mortgage broker. In my opinion, there's a
Yeah.
whole list of product knowledge. You can
Yeah.
talk product knowledge, you can talk sales knowledge, you can talk all those things, I guess. But for me,
Yeah.
that to me is the biggest measure.
I mean, I and it's funny that you brought that up because that's one of the biggest reasons why if somebody comes to me and says, like, should I go for bank or mortgage broker? I always lean mortgage broker because nowadays I feel like it's not what it used to be, and when I say used to be, before my time, where you do have long-lasting relationships with the professionals that you work with. So you go to the bank, you meet the same guy, and that person will do your mortgage. Then if you need a credit line, they'll help you with the credit line. Your kids go to college, he'll help you refinance your home for that. You don't have that at the banks
Yeah,
anymore. Because there's just a lot of churn, there's a lot of turnover, so you're not going to have somebody who understands who you are as a person, and throughout your kind of your lifetime, for lack of better words, to understand
sure.
what you're going to need when you have a few kids, when you need an extension on the house, all of that. And mortgage brokers can always look at what you have and then put you into the best product you possibly can, instead of trying to force you into one bank without really understanding your needs are in that same level a mortgage broker does. Not that I hate banks.
Yeah,
I mean, I work with banks all the time. We're happy to work with banks, but it's just that personal touch isn't there, is what I kind of see.
sure. Yeah, it doesn't suit me or either of us, I suppose, to speak ill of a bank, and
Yeah.
it's something that we try and tell our staff and our agents as well. My paycheck and my money has to go and come from somewhere as well.
Yeah.
So I mean, I have a for a bank, and I still keep accounts at the TD branch that I worked at, almost 20 years
Mm-hmm,
ago.
mm-hmm.
That said and done, as to your point, the staff turnover that's taken place there over that time. Has left almost nobody that I would have worked with or known at that point. So it is a symptom of the type of company, the type of business that a bank is, in my opinion. But that's not that that concept of turnover, of people getting promoted or people moving on or whatever, is not just limited to the banking world, for
Yeah.
example. So, no, I appreciate your comment. The idea of a mortgage broker, somebody who is tenured, somebody who has known. I'm the more and more over the last year or two, I find myself, looking in things and looking at comments I've made or things I've said or saying things to our people. And I'm like, oh yeah, these are the things that my boss has said to me, now 15, 20 years ago. And it's ironic and a little ground shaking for me to sort of be in that position,
Yeah.
where I'm the one passing advice on, Lord help us. But that's one of the things that we've always tried to say to our people is, like, somewhere along the line we all need a bank at some point.
Yeah.
Um, and we should be mindful of that.
Yeah.
I am at a point now where I am arranging mortgages for the children of my first clients from years and
Oh
years ago
wow.
and stuff like that. So there is some value to the consistency. I know that they appreciate that, and generally speaking, if you can serve a customer well, if you can serve a homeowner or a prospective homeowner well, as I suggested a few
Mm-hmm.
minutes ago, then they won't care where their mortgage comes from, right? And it gives us a lot of freedom to be able to say, we do believe that this is the best fit, regardless of what one's perception might be of a bank versus a non-bank lender, for example.
Yeah, and that brings me to like another point where I feel like again, I'm not I love banks. I'm not saying that you shouldn't go to a bank, but just the
You're among friends. Don't worry. You're among
the
friends.
difference is, in terms of a bank and a mortgage broker, is basically a bank's only going to sell you their products because they can't sell you anything else. Fair enough. And just the regulatory environment is insane, so a bank can't offer you everything. So if your shoe size is a 10 and they've got a 9 or an 11 and they don't have 10, they're going to give you an 11. It's not going to be the perfect fit, which is why I always say mortgage brokers have so many lenders that you're able to kind of get that right fit that you need for that time being, and then move forward. And to that point, and we spoke about this a bit earlier as well when you spoke last, was the fact that working in different markets, like you said, banks and different lenders have different lending criteria, which is also why it's important to go to a mortgage broker who understands all of that, who can then place you in the right product for the particular house or property that you're buying.
Yeah, without question. I mean, options mean savings. Options mean flexibility.
Yeah.
Options mean all kinds of things. And I would not, obviously, I've made my living now doing this for a long time. I wouldn't argue with any of that. It's important to note, I guess, that there are exceptions to that. Some of my best friends, clients, referral sources are also competitors within the banking world. Some relationships that we've forged over a lot of years, and there are exceptions to the banking rules, I guess, meaning there are people who do good work for the bank as well. It's
Mm-hmm.
important that we should
Yeah.
at least maybe comment on that, I guess.
Yeah.
It does seem to be more the exception than the rule, as in, like you just said, that shoe size thing is a good analogy. Although on the brokerage side of the business, it does seem like fitting that, finding that size 10, as you suggested, is not always an easy task, even on the broker side these days. It's a bit of a wild west out there at this time, as I'm sure you know. But yeah, certainly I'm happy. It does make me happy to know that when somebody does come into my office, our company usually represents, somewhere between, 28 and 35 different mortgage lenders over the course of any given
Mm-hmm.
year. And that kind of flexibility, people do appreciate over time. As we said, or as I said a minute ago, if we're the ones, serving that customer, if you were to ask one of my customers or one of my company's
Mm-hmm.
customers, as their mortgage, they're going to say Leigh Graham, or they're going to say the mortgage professionals. They're not going to say TD Bank
Yeah.
First National Financial, for example. That's assuming that we've done our job properly, which is, again, serve them well, serve them graciously, serve them directly. Don't BS. Don't tell them things that aren't true.
Yeah.
And those things come naturally to a lot of people in any sales profession. It's very easy to say, oh yeah, we should, this should be fine, or we'll be able to get this done, and then find out, halfway through the process there's a problem, right? So
Yeah.
I believe that the
Yeah.
flexibility does provide the consumer a greater degree of economic advantage for
Uh-huh.
sure.
So walk me through what it's like to work with you in your firm. So if I need a mortgage, do I just give you a call? Should I email you? Am I walking into your office? Am I doing this online? What is it like to work with you? What's the entire process?
Yeah, great question. One of the things that I always enjoyed about working for the former owners of our company was that there was very little mandate, from the sense of, here's the lenders that we deal with, or here's, the type of business that we do. For example, the brokerage would provide, a conservative but a base level of,
Mm-hmm.
regulatory framework with which we had to work. Um, and, um, and essentially then from then on just gave us the freedom to do business with the lenders and the customers that we would choose. So we have 26, 27 licensed agents in our company. You'll have you could potentially have 25 different experiences, or 27, 28 different experiences, depending on who you call. Okay.
Yeah.
So that's sort of maybe that's a fluffy answer to that question, but most of us in the Kingston area up until 2020, um, would still meet our customers in person, right? Kingston's a relatively small town. I think we're at about 140,000 people now. And it's not the end of the world to be able to drive across town or into town to meet with your mortgage broker. So that is essentially how we did 99% of our business: was set up the appointment, bring your documents to the office, we'll copy them, scan them right there, give them back to you. We'll shake your hand, we'll look you in the eye, we'll do all the things that got this company from where it started, and to where it is now. There's no question in my mind that I think if we were a younger company, or if there had been some of us who had started more recently in this business, that the transition to the digital world over the last 2 years would have been much more difficult. It was difficult enough, I think, for many of us
Mm-hmm.
who, including myself, and I'll be the first to admit it, had never used DocuSign prior to March of 2020. I'd never had any need for it. Which is amazing to say at this point in time, but 2 years ago it was a reality. So in today's environment, you're going to find a balance. There are still some of our people who are preferring to meet their customers in person. So you would give them a call, they would schedule an appointment, next Tuesday at 3 o'clock, and you would show up at the office and conduct your business. My preference now is online. What I have found, of course, and I'm embarrassed to admit that I didn't figure this out many years ago, is the efficiencies that can be created when when things are done digitally. Um, has effectively led to a couple of things. One of which is more work getting done. That's an increase in volume. That's an increase in revenue. So those are good for me. But it also saves the consumer a fair bit of effort as well. And in my opinion, overall, a much smoother and more efficient transactional experience. But there's no question that you lose a bit of. There's always a risk of losing a bit of that personal connection, which is really the only reason, or the biggest reason why this company is as successful as it is, why we've been able to sustain what we've been doing, why we've been able to grow what we've been doing. And again, there's no question in my mind that if my tenure in this business wasn't quite as long, somebody starting in this business in 2018 or 19, I think would have probably struggled a lot more to grow a business over the last few years. So I think I don't want to speak for my partners necessarily, but we all consider ourselves very fortunate to have had the time in the business before we had this disruption 2 years ago. And I say disruption. I'm well aware that there are mortgage brokers who operated
Mm-hmm.
entirely digitally
Mm-hmm.
long before that.
Yeah,
Right?
yeah,
It just wasn't us.
yeah.
So that's sort of a long-winded answer to your question, but it depends on who you call. Right now, my preference is we're going to do a phone call. We're going to collect things by email, Dropbox, Google Drive, sharing things as securely as possible. And we'll conduct transactions. I think I met two customers in person over the last year, and they were usually older friends of my in-laws who maybe didn't have
Yeah,
email addresses
yeah.
or something like that. So it's important not to draw a line anywhere. You have to be able to accommodate your
Mm-hmm.
customers' needs. But my preference at this particular moment is going to be a digital or an online experience.
Yeah. No, I mean, our firm turned not completely. Like you said, I probably in the same ballpark as you probably met like a customer or two in the past year or two that came in the office. But we find that like when you're meeting them online, clients don't have to travel. At least if you're in the GTA, you're traveling 30 minutes. 45 minutes anywhere to get anywhere, and it's what you to get to the office to get back. You wasted about an hour, hour and a half, and a lot of people could just do the entire meeting during the lunch break, so they don't really have to take some time off or coordinate too much. So it always for us. I mean, I thought it was. I'm not gonna say it's a blessing. COVID wasn't a blessing, but it did ease certain things for us. Um,
Yeah, agreed.
just to change gears a little bit, I do want to talk about a little bit about just the market, and the market just seems to be going crazy. I think last week, um, we had another 50 basis point hike by the Bank of Canada, um, which gets some people to think like the sky is falling, rightfully so. If you're on a salary and you're thinking, okay, I have a variable mortgage, my payments may be going up, or I'm paying more interest, and it makes people get into a panicky mode. In your opinion, and this is a bit of a crystal ball question, um, where do you think interest rates are going by the end of this year? So we're halfway through. Where do you think we're going to be December 2022?
Yeah, the crystal ball question is a great one. Those are our favorite, just in case you're wondering. Um, the Well, there's a couple things. The first thing I want to throw at you just quickly is uh, that headlines are there for one reason, and they're there to
Mm,
sell newspapers. There is no question that things are becoming more expensive, but more expensive compared to what? And that's what really, to go back to your very first question, maybe about what makes a good mortgage broker. I would say that 90% of the transactions that I wrote in 2021 were variable rate mortgages,
mm-hmm.
but they were followed up with, communications to our customers, in many cases, videos that were created using spreadsheets that can outline what the forecasts are to say, listen, if you were to lock in now, yes, there's some stability, but there's also some risk. Um, and again, just making sure that your customer is educated enough to have made that decision, but also be comfortable with it moving forward. Um, that's something that fosters loyalty, it fosters
Mm-hmm.
appreciation, and regardless of what the market does, if they trust that you have their best interests at heart, it can alleviate a lot of stress. I was in this. I don't, as you can see, my office has become mostly a storage facility over the last few years, and I don't work from this room very often. But I came in here on Wednesday morning last week, knowing that as soon as that announcement took place, that my phone was going to blow up, and sure enough, it did because we've got I don't even know, 1,000 customers in variable rate mortgages, and everyone is asking the exact same question, right? To your question about the forecast, I'm a huge follower of Benjamin Tal. He's sort of the most he's the deputy chief economist with the CIBC. I don't know if you're familiar with him or
Hmm.
not.
Yeah.
He tends to be the most widely regarded voice on variable rate mortgages. I grew up with, I came up through the ranks, under my mentor, sort of learning his mindset and stuff like that. And I found that, if you were to actually go back and look at, exactly what his forecasts were, it's not really prudent to say whether they were accurate or not necessarily, but really what he's really good at is paring away why things are happening. And his most recent comments, include things like fixed rates are rising because of the Bank of Canada dumping all the bonds they bought in 2020. Variable rates are rising because of inflation. Inflation is still high and potentially growing because of the supply chain disruptions that
Hmm.
are still in place because of COVID. And these are both temporary factors. Okay, I'm not an economist. I have no idea what's going
Yeah.
to happen. Okay, but the general consensus seems to be that things will hit a peak before the end of this year. And historically, again, coming from someone who, lived through the crash of 2008 and nine, lived through some of the overshoots that came from them raising rates, through a past previous recessions. Generally, what will happen is they'll be super aggressive. They'll overshoot a little bit, and then things will settle back down again. That's what I believe will happen. Again, it's impossible to say. The
Yeah.
state of the world, as we've seen, can change overnight. But in general terms, I think we've absorbed maybe 3 or 4 years worth of market activity into maybe 1 year, and that's unprecedented. And it does
Yeah.
make people nervous. But I think by the end of this year, we'll have a little better handle on what the next 3 to 5 years will look like interest rate wise. We just got to get there, right? So
I mean, are you
that's my opinion.
yeah,
But go ahead.
but are you still recommending variable rates, or are you moving towards fix? What's your recommendation for clients walking into your office?
Yeah, that's a great question. I am a believer in the variable rate mortgage, and I'm a huge proponent for it for a number of reasons. The primary one being flexibility. It's still a very small percentage. It's still the minority of mortgages that run a full 5 year term in this country.
Yeah.
Circumstances change, people move, somebody dies, somebody gets sick, people divorce, they sell, they upgrade, whichever, and because of the nature of lenders and where lenders' money comes from and funding sources and things like that, it's not a safe assumption, to think that the lender you're with today is going to be the lender you're with when you move to the next house.
Yeah.
It could be, and it should be, and that might be the most economical choice, but history suggests it's not actually the case, because of whatever, because of a market change, because of a policy change, because of a change in the customer circumstances.
Yeah.
So again, this mindset of, well, we're locked in for 5 years and we have this stability. Well, the majority of mortgages are going to change during that time, and so when that changes, the biggest thing for me personally has been the reality of what kind of penalty cost that consumer, that homeowner might face when they have to make that change. And the variable rate mortgage essentially eliminates that risk, in my opinion. That risk is offset, however, by the risk of rising rates.
Yeah.
So again, it puts a lot more work on our shoulders to be able to have to manage that for a customer. There's no question, right? Our compensation is identical, fixed or variable in most cases. So it's not like we don't
Hmm.
have an incentive to offer variable rate mortgage, except when we believe that it's the right thing for that customer. So,
Hmm.
in today's environment, if we have a first-time home buyer with minimal fallback position who's borrowing their last 5 grand from their dad to get their first house and get their keys, regardless of what that fixed rate is, and we're now in the mid 4% range for a first-time insured home buyer, that to me is an easy one to say. Listen, this is probably the best choice for you guys. It gives you the stability. Every other cost associated with owning a home is going to change. Your taxes are going to go up, your hydro is going to go
Yeah.
up, your water bill is going to go up. Why not fix your mortgage for 5 years? But sign here acknowledging the fact that, we're recommending that you stay here for 5 years and not make any changes. And we're pretty clear about that as well. Obviously, you can't control what people do in the future, but making that known to them, if rates do come down and they decide to make a change at that time, they may simply not be able to. The cost to change may simply be too
Yeah.
high. But a more seasoned, a borrower with more equity or more, job stability behind them, or a little bit of a fallback position, those metrics don't really, you know, the decision between what product we recommend are based on the same things that they've always been. Can this consumer absorb any risk at all? And if the answer is yes, then we will recommend a variable rate mortgage.
Yeah.
The nature of my business now is not first time home buyers. The first time home buyers are the kids of my
Yeah.
clients.
Yeah.
So which is fine, which is great, and it's again, I'm so very fortunate to be in that position. Um, but much of my customer base now is repeat multiple time customers.
Mm.
Loan to value ratios are relatively low. Salaries are at the highest time that they'll ever be these borrowers' careers.
Yeah.
So the comfort for me to be able to say, take a variable rate mortgage, regardless of what that discount or prime rate might be doing, is much higher now than it would have been even, three, five
Yeah,
years
I
ago.
mean, I find that people, and there has been a lot of talk of like just locking in from a variable, because a lot of people did get into variables. I'm a big proponent of variables. I've seen that variables always outperform fixed, and like you said, you have that optionality, or it's cheaper optionality to get out. You pay a penalty either way, but the variable has a lower penalty. But I find it just interesting how a lot of people were like, you know what, we should. Convert it into a fixed, and I feel like when you move it into a fixed, you're paying the fixed rate, right? It's not like you're fixing into that variable rate. You're fixing into whatever fixed rate is at that time. Is that correct? So you
That's correct. Yeah, you're locking into whatever the market is demanding on the day that you
yeah.
actually make that decision.
So there's clients who are saying I want to pay more now because I might be paying more tomorrow. So that's basically what the argument is when they're trying to move into a fixed, where it's like, you know what, like in the long run, you don't know how long the interest rates, if they do go higher than fixed, how long they're going to be that high, and also when you're paying down your mortgage on a variable, you're actually paying down more equity. So your interest rate could go up and you still pay less interest over that term, even if you write it out until to the end of the 5 years. Even though most Canadians, I think, and you'd know better, I think the average is 3.5, 4 years is how long Canadians stay within a mortgage. But even if you're within the 5 years, if you paid off enough equity in the beginning, even if it kind of does go a little bit higher towards the end, or you're paying higher interest, you're still not, you're paying less interest overall, just because you've brought down that equity so much that the interest rate on that is more manageable, which is what I find, like, people don't really see those numbers. They just see that rate and they're like panic.
Yeah, it as I said a minute ago, it places a lot more responsibility on the shoulders of the originator of the mortgage, myself, my team. The person who's arranging that mortgage has, in my opinion, a very, very, very large responsibility, especially in a market such as this, where every day it seems that fixed rates are going up and up and up. To educate the consumer, the homeowner, on exactly what you just said, which is, okay, the real advantage to a variable rate mortgage, for example, when the rates are as different as they are at this moment, is what's being done with the money that's being saved. And all we can do is say, you should be using that money, to pay your mortgage down faster, or at the very least put it aside, for example, for a rainy day. Whether the consumer does that or not is
Mm-hmm.
excuse me, is up to them. Um, but the strategy that I recommend, and we've got a nifty little spreadsheet that, if you were interested, I'd be happy to share with you at some point. That allows us to manipulate, um, what we think the interest rates are going to do. So we can go super aggressive and assume that rates are going to go sky high. We can assume that they're going to,
Mm-hmm.
skyrocket this year, which is effectively a given, and then maybe over the next year or two they come back down again, for example. So we have a sheet that allows us to sort of demonstrate to a customer what would happen in those cases. And the single most important thing to understand is that, as you suggested, if you were to lock in, whether it's now, whether it's last year, whether it's next year, right? The reality of paying more is there. So you have to understand that your payments are going to be higher. So what do we recommend? We recommend a customer already be paying more. So in a variable rate mortgage, the majority of our customers are already increasing their payments to either what a fixed rate level would be, if not higher,
Mm-hmm.
understanding that even a 5 year fixed term will expire at some point and you're still going to owe money. And we don't know what rates are going to be in 5 years. And we should be prepared for that as well. So that's something that I've taken, even prior to this current market, that's something that we would do on an annual basis for our customers, just prepare a prepayment demonstration. What's going to happen if you
Yeah.
increase your payment by $100 a month, $200 a month? Pick a nominal number that's generally affordable, and demonstrate how you're going to pay that mortgage down faster. And as you said, the faster the balance comes down, the less interest is paid overall. So those are things that make, to ask what makes a good mortgage broker. That's another one, in my opinion. To be able to demonstrate over the life of a mortgage, of a consumer's mortgage, how little behaviors can change can change your debt load, reduce your debt load over time. That's huge. So as far as the variables go, it's not prudent, in my opinion, to just take the base level. You have to understand that that payment's going to be higher. You have to have started paying
Yeah.
more of that money that directly decreases your debt load on an accelerated basis, giving just effectively building that buffer so that if things do become so high that a consumer sitting there thinking, wow, like this is actually getting now expensive or beyond what our
Yeah.
initial comfort zone might have been, that they're prepared for that to happen.
No, yeah, awesome. You know what? Like talking to you, and I'm just to wrap this up. I wanted to end it off with this comment was that most brokers, or most professionals, they're very good at what they do, and you certainly are. But you're also looking kind of into the future as to not only what the interest rates are in the products that you can offer to your clients, but um, finding more meaning behind those interest rates, like you said, following the economists at CIBC and everywhere else to see where those interest rates are going, which is why I always kind of advocate, again, I'm going back to the same thing, brokers, because when you're passionate about something and you know where it's going, even if variable interest rates or any interest rate is going up today, you know where it's headed. It's like Wayne Gretzky says, don't skate to where the puck is, you got to skate to where it's going. So you
Yeah.
need a mortgage professional for this reason to show you where the puck is going, because for all of us, and myself included, being a real estate lawyer, I'm kind of in this, but I only see one aspect of it. I still don't know where the puck is going. I only see where it is. And so for that, you know what? I thank you for joining the podcast. If anybody wants to reach out to Leigh, I'm going to leave his contact information below. Shoot him an email, give him a call, and make sure you ask for that spreadsheet to make sure you can figure out how much you save through variable and fixed. Thanks for being on the podcast, Leigh.
Thanks for having me, man. Appreciate it.
No problem.
Pleasure.